Hey traders, welcome back to the channel. Today we're diving into the world of technical indicators, the tools that can give you insights into market trends, help make your trading decisions easier, and ultimately increase your chances of success in the markets. Whether you're a beginner or looking to refresh your knowledge, we've got you covered. Let's get started. First things first, let's define what a technical indicator is. A technical indicator is a mathematical calculation based on a security's price, volume, or open interest. These indicators are typically displayed on charts and help traders identify patterns or trends, measure volatility, and even predict future price movements. Think of them as your trading assistant, guiding you through the market. There are hundreds of technical indicators out there, but today, I'll be covering a few of the most popular ones that traders commonly use to make informed decisions. The moving average is one of the simplest but most powerful tools. It smooths out price data to help you identify the direction of the trend. The two most common types are the simple moving average, SMA, and the exponential moving average, EMA. The SMA is calculated by averaging the closing prices over a specific period of time. It's best for identifying long-term trends. The EMA, on the other hand, gives more weight to recent prices, making it more responsive to price changes. The 50-period EMA is often used to identify the medium-term trend, while the 200-period EMA is popular for long-term trends. Both are widely used for spotting support and resistance levels. Next, let's talk about the RSI. This indicator is used to measure whether an asset is overbought or oversold, which could indicate a potential reversal. RSI ranges from 0 to 100. Typically, an RSI over 70 means the asset is overbought, and below 30 means it's oversold. An example could be, if the RSI is above 70, it could signal that the market might be due for a pullback, and if it's below 30, the market might be due for a bounce. Moving on to the MACD, a widely used momentum indicator. It helps to identify trend changes and momentum shifts by comparing two moving averages, the 12-day EMA and the 26-day EMA. The MACD line is the difference between these two EMAs, and when it crosses above or below the signal line, a 9-day EMA, it's seen as a potential buy or sell signal. Additionally, traders look at divergence between the MACD line and price action. If the price is rising but the MACD is falling, it could signal that the trend is losing momentum. Next up, we have Bollinger Bands. These bands consist of a middle band, which is usually a 20-period SMA, and two outer bands that are two standard deviations away from the middle. The bands expand when the market is volatile and contract when the market is stable. Traders use Bollinger Bands to look for potential breakouts. When price touches the upper band, the asset could be overbought, and when it touches the lower band, the asset could be oversold. Additionally, the Bollinger Band squeeze, when the bands come close together, often precedes a big price move. Now that you know about some key technical indicators, let's talk about how you can use them in your trading strategy. Here's a simple approach. 1. Identify the trend. Use indicators like the moving averages or MACD to identify the prevailing trend. Are prices trending upward or downward? Once you know the trend, you can trade with it, not against it. 2. Spot overbought or oversold conditions. Use the RSI to determine when the market is overbought or oversold. This can help you spot potential reversal points, allowing you to enter or exit trades at the right time. 3. Find entry and exit points. Combining indicators like the RSI, MACD, and Bollinger Bands can help you pinpoint great entry and exit points. For example, if you see the RSI is below 30, oversold, and the MACD crosses above its signal line, it could be a great time to buy. 4. Confirm with price action. Always use price action to confirm what the indicators are telling you. Look for key levels of support and resistance, candlestick patterns, or chart patterns like triangles and head and shoulders for added confirmation. While technical indicators are powerful, they are not foolproof. Here are a few best practices to keep in mind. Don't rely on one indicator. Combine multiple indicators to get a more reliable signal. Always use a stop loss. Protect yourself from large losses by using a stop loss order. Backtest your strategy. Before diving into live trading, backtest your strategy on historical data to see if it holds up. Adapt to market conditions. Different indicators work better in different market conditions. For example, the MACD may work better in trending markets, while the RSI might be more useful in sideways markets. Remember, indicators are tools to aid your decision making, but it's important to understand market fundamentals and practice risk management. So there you have it, a quick guide to some of the most popular technical indicators and how to use them in your trading. Keep in mind, no indicator is perfect, but using them in combination and understanding how they work can definitely give you an edge in the markets. If you're just starting out, don't feel pressured to use all the indicators at once. Pick a couple of them, practice, and build your confidence. Remember, trading is a marathon, not a sprint. If you found this video helpful, please give it a thumbs up, subscribe for more trading tips, and let me know in the comments if you'd like me to dive deeper into any of these indicators. Thanks for watching, and happy trading. Until next time, traders, stay disciplined, stay patient, and let the charts do the talking. See you in the next video.